What the stock market really rewards and what it punishes. Let me tell you something most Americans misunderstand for decades. The stock market is not random. It is not chaos. It is not a slot machine. It is a weighing machine of behavior, and it rewards certain behaviors relentlessly. It punishes others just as consistently. I am 84 years old. I have watched Americans build fortunes from modest salaries, and I have watched high-income professionals retire with anxiety because they misunderstood what the market truly rewards. The market does not reward intelligence alone. It does not reward activity. It does not reward bold predictions. It rewards temperament. It rewards structure. It rewards patience. And it punishes ego, urgency, fear, and the need to feel clever. Most Americans think the stock market rewards people who are good at picking stocks. That's a myth. The market rewards people who survive long enough for compounding to do its work. Let me explain what I mean. What the market rewards: time. The greatest edge in investing is not information, it is time. A 25-year-old investing $400 per month into low-cost index funds tracking the S&P 500 has an advantage over a 45-year-old investing triple that amount. Not because they are smarter, because they started earlier. Compounding is mathematics, not magic. If you earn an average annual return of 8% and reinvest dividends, your money doubles approximately every 9 years. 9 years. That means $100,000 becomes $200,000, then $400,000, then $800,000. But only if you do not interrupt the process. And here is what the market punishes: interruptions. The average American investor underperforms the market by several percentage points annually, not because the market failed, because they panic sell during downturns. They chase performance during rallies. They time entries and exits emotionally. The stock market rewards consistency. It punishes reaction. What the market rewards: ownership mentality. When you buy a stock, you are not buying a flashing number on your phone. You are buying partial ownership in a business. That business produces goods or services. It hires employees. It innovates. It generates revenue. It competes. When Americans forget that, they trade instead of invest. They treat shares like lottery tickets. They check prices every hour. They celebrate green days and fear red days. But if you owned a rental property, would you revalue it every 30 minutes? Of course not. You would care about long-term cash flow. The stock market rewards people who think like owners. It punishes people who think like gamblers. What the market rewards: discipline during boring years. There will be years where your portfolio barely moves, flat years, frustrating years, years when headlines scream about recession, elections, global conflict, debt ceilings, inflation spikes. You will feel tempted to do something. That impulse is expensive. The market rewards boring behavior: automatic 401k contributions, automatic IRA deposits, rebalancing once a year, ignoring daily noise. The market punishes constant adjustment. It punishes hyperactivity. Activity feels productive. It often destroys returns. What the market punishes: ego. Ego is the most expensive trait in American investing. I have seen engineers, surgeons, executives, brilliant people believe they could outsmart markets consistently. They concentrated portfolios into single stocks. They ignored diversification. They dismissed risk. And when the inevitable correction came, they learned humility. The market does not care about your resume. It does not care about your confidence. It does not care how strongly you believe in a company. It cares about cash flow, earnings growth, and macroeconomic reality. Diversification is not exciting, but it survives ego. What the market rewards: emotional control during crashes. Every American investor will experience multiple bear markets. It is not a possibility. It is a certainty. Markets decline 20%, 30%, sometimes 50%. In those moments, you feel physically uncomfortable. Your retirement balance shrinks. Headlines predict collapse. Friends say, "This time is different." This is where wealth transfers occur. The market rewards those who continue systematic investing during downturns. It punishes those who sell at maximum fear. Crashes feel like punishment. They are actually opportunity for those with liquidity and discipline. The market rewards long-term conviction in productive businesses. It punishes short-term panic. What the market rewards: margin. Let me speak directly to Americans over 40. You earn decent income. You work hard. But retirement feels fragile. Often the issue is not returns. It is margin. The gap between what you earn and what you spend. If you invest 15% of your income consistently, you build optionality. If you invest 3% and expand lifestyle expenses with every raise, you build stress. The stock market rewards capital inflow. It punishes lifestyle inflation. Compounding requires fuel. Savings rate is fuel. What the market punishes: timing obsession. Timing the market is one of the most common American investing mistakes. People wait for the perfect entry. They sit in cash during uncertainty. They try to predict elections, Federal Reserve moves, inflation reports. They wait for clarity. Clarity arrives when prices are already higher. The market rewards participation. It punishes hesitation rooted in fear. Time in the market historically outperforms timing the market. This is not motivational language. It is statistical reality. What the market rewards: low costs. Fees compound negatively. A 1% annual fee may sound small. Over 30 years, it can reduce your portfolio by hundreds of thousands of dollars. Low-cost index funds, often charging 0.05% to 0.10%, allow more of the return to remain yours. The market rewards cost efficiency. It punishes unnecessary complexity. Many Americans chase sophisticated strategies when simple diversified index exposure would outperform them long term. Complexity feels intelligent. Simplicity compounds. What the market punishes: cash hoarding. Cash feels safe. It is stable, predictable. But inflation silently erodes purchasing power. At 3% annual inflation, money halves in real value roughly every 24 years. Doing nothing is not neutral. It is loss by erosion. The stock market historically outpaces inflation because businesses adjust prices, innovate, and expand. The market rewards ownership in productive assets. It punishes stagnation. What the stock market really rewards and what it punishes. Let me take you deeper, because understanding behavior is not enough. You must understand structure, especially if you are over 50. What the market rewards after 50. Many Americans make a dangerous shift in their 50s. They move heavily into cash. They reduce equity exposure dramatically. They become hyper-conservative out of fear of another crash. I understand the instinct. You feel closer to retirement. You feel like you have less time to recover. But here is what the market punishes: overcorrection. Retirement is not a single moment. It can last 25 or 30 years. If you eliminate growth entirely at 60, inflation becomes your silent enemy. You need growth in retirement, not aggressive speculation, not concentrated bets. Measured, diversified exposure to productive businesses. The market rewards balanced courage. It punishes emotional retreat. What Americans get wrong about risk. Most people define risk as volatility. They see their account drop 15% and say, "This is risky." Volatility is temporary. True risk is permanent impairment of capital. True risk is running out of money at 82. True risk is being forced back to work at 74. True risk is holding too much cash while inflation erodes your purchasing power. Diversified index funds representing thousands of companies reduce permanent risk. Concentrated bets increase it. The market rewards diversification. It punishes concentration driven by confidence. The quiet punishment of inflation in 2026. Inflation does not feel dramatic. It feels gradual. Groceries slightly higher. Insurance premiums slightly higher. Medical costs creeping upward. At 4% inflation, purchasing power halves in about 18 years. If your savings earn 1%, you are losing ground every single year. Slowly, silently. This is why the market rewards ownership in businesses. Businesses raise prices. They adjust margins. They grow earnings. Equity ownership historically protects purchasing power over decades. Cash does not. The market punishes those who mistake safety for stillness. The biggest mistake I see repeatedly. This one pains me. Middle-class Americans increase lifestyle faster than investments. Income rises. Spending rises faster. Homes upgrade. Cars upgrade. Subscriptions multiply. Vacations expand. But investing remains flat or inconsistent. The stock market rewards steady capital contribution. It punishes sporadic participation. Compounding needs consistency. It does not function on enthusiasm. It functions on repetition. The most powerful investors I have known were not flashy. They were consistent. What the market rewards. Systems. Emotion is expensive. Systems are profitable. Automatic 401k contributions. Automatic Roth IRA funding. Automatic brokerage transfers. Rebalancing annually. Ignoring daily financial media. The market rewards systems because systems remove emotional decisions. Most Americans do not fail because of bad markets. They fail because of emotional responses to normal markets. Structure defeats emotion. What the market punishes: short time horizons. If you need the money in 12 months, the market is dangerous. If you need the money in 20 years, the market is historically powerful. Time horizon determines suitability. The shorter your horizon, the more volatility matters. The longer your horizon, the less it matters. The market rewards long horizons. It punishes impatience. The hidden advantage of ordinary Americans. You may not have institutional access. You may not have insider data. But you have something powerful. You can think long term. Institutions answer to quarterly results. You answer to decades. You can ignore short-term volatility. You can automate. You can stay quiet. That flexibility is an advantage. The market rewards patience more than prediction. What the market never rewards. Let me make this clear. It never rewards panic. It never rewards ego-driven concentration. It never rewards chasing last year's winners. It never rewards trying to outguess Federal Reserve decisions. It never rewards emotional decisions made at 2 a.m. It rewards discipline every time, over decades. A framework for normal Americans. If you are starting from scratch, build a 3 to 6 month emergency fund. Eliminate high-interest consumer debt. Capture full employer 401k match. Begin diversified index-based investing. If you are mid-career, increase contributions with every raise. Avoid lifestyle creep. Monitor fees. Stay invested during downturns. If you are nearing retirement, gradually rebalance. Maintain some equity exposure. Plan tax-efficient withdrawals. Avoid dramatic shifts based on headlines. Normal Americans do not need complex derivatives. They need discipline and time. The emotional reality. There will always be fear. Elections, wars, debt crises, AI disruption, bank failures. Media thrives on uncertainty. But over 100 years, American enterprise has continued. Innovation has continued. Productivity has continued. The market reflects that over long horizons. The stock market is not a morality machine. It does not reward good intentions. It rewards productive capital deployed over time. Let me leave you with this. The market is not something to conquer. It is something to cooperate with. You do not need to outsmart Wall Street. You need to outlast your own impulses. Patience is the rarest financial advantage in America, and it costs nothing. Build ownership, protect margin, respect compounding, ignore noise, think in decades. That is what the stock market truly rewards, and that is what it relentlessly punishes if you refuse to learn.